Hello everyone, welcome to my channel. Introduction. Real estate has always been one of the most popular and trusted forms of investment across the world. For generations, people have believed that owning land or property is a symbol of stability, security, and long-term wealth. Unlike financial assets such as stocks or bonds, real estate is a physical, tangible asset, something you can see, touch, and use. This makes it emotionally appealing and psychologically comforting for many investors. In this detailed explanation, we will explore what real estate investment really means, the different types of real estate, how investors earn returns, the challenges involved, and why measuring real estate returns is not as straightforward as other asset classes. Whether you're a beginner or someone looking to understand real estate more deeply, this guide will give you a clear and structured understanding of the topic. What is real estate investment? Real estate investment involves buying, selling, or leasing land and properties with the intention of earning income or generating long-term wealth. These properties can be commercial or non-commercial, depending on their purpose and usage. When we talk about real estate, we are referring to a wide range of assets, such as residential plots, apartments, independent houses, commercial buildings, office spaces, retail shops, industrial land, farmland. Each of these categories has its own characteristics, risks, and return potential. But at the core, real estate investment is about owning property and benefiting from its value over time. Types of real estate. Real estate can broadly be divided into two categories. 1. Residential real estate. This includes properties meant for living purposes. Examples: apartments, villas, plots, independent houses, builder floors. People invest in residential real estate either to live in it or to rent it out for monthly income. 2. Commercial real estate. These are properties used for business activities. Examples: office buildings, retail shops, warehouses, malls, hotels, industrial units. Commercial real estate usually requires a higher investment, but also offers higher rental yields. How real estate investors earn returns. Real estate generates returns in two primary ways. 1. Rental income. Rental income is the money earned by leasing out a property. This is a steady, predictable source of cash flow. For example, a residential apartment may earn monthly rent. A commercial shop may earn higher rent due to business activity. An office space may be leased to a company for long-term contracts. Rental income is attractive because it provides regular cash flow, similar to interest from fixed deposits, but often at a higher rate. 2. Capital appreciation. Capital appreciation refers to the increase in the value of the property over time. For example, a plot bought for 20 Indian rupees lakh may be worth 40 Indian rupees lakh after 10 years. An apartment purchased for 50 Indian rupees lakh may appreciate to 80 Indian rupees lakh, depending on location and demand. Real estate prices generally rise due to urban development, infrastructure projects, population growth, demand for housing, commercial expansion, inflation. Capital appreciation is the main reason many investors choose real estate. The potential for long-term wealth creation. Why real estate is popular. Real estate remains one of the most preferred investment options for several reasons. 1. Tangible asset. People trust what they can physically see and own. 2. Hedge against inflation. As prices rise, property values and rents also increase. 3. Emotional security. Owning a home gives a sense of stability and pride. 4. Long-term wealth creation. Real estate has historically appreciated over long periods. 5. Passive income. Rental income provides steady cash flow without active effort. The complexity of real estate transactions. Unlike buying stocks or mutual funds, real estate transactions are not simple. They involve multiple steps, legal checks, and documentation. This complexity is one of the biggest challenges for new investors. Here are some reasons why real estate transactions can be complicated. 1. Legal verification. Before buying a property, the buyer must verify ownership documents, title deed, encumbrance certificate, land use permissions, building approvals, tax receipts, RERA registration, if applicable. Any mistake in verification can lead to legal disputes or financial loss. 2. High cash outlay. Real estate requires large amounts of money. Even a small apartment can cost several lakhs or crores. This makes real estate less accessible compared to other investments like stocks or mutual funds. Many investors take home loans, which adds interest cost, EMI burden long-term financial commitment. 3. Low liquidity. Real estate cannot be sold instantly. Finding a buyer takes time. This makes real estate a less liquid investment compared to stocks, which can be sold in seconds. 4. Maintenance and upkeep. Properties require repairs, renovation, maintenance, charges, property taxes. These costs reduce the overall return. Why real estate returns are hard to measure. Unlike equity markets, where returns are measured using metrics like CAGR, index performance, or NAV, real estate does not have a standardized return measurement system. Here's why. 1. No centralized market data. Real estate prices vary widely based on location, builder, demand, infrastructure, city development. There is no single database that tracks real estate prices accurately. 2. Subjective valuation. Two similar properties in the same area may have different prices due to floor level view, age of building, amenities, negotiation skills. This makes return calculation inconsistent. 3. Hidden costs. Real estate returns must consider stamp duty, registration, fees, brokerage, maintenance, renovation, loan interest. Most investors ignore these costs, leading to inaccurate return expectations. 4. Long holding period. Real estate is usually held for many years. During this time, market conditions change, making return measurement difficult. Risks in real estate investment. Every investment carries risk, and real estate is no exception. Some common risks include market downturns, legal disputes, delayed construction, fraudulent sellers, poor rental demand, high maintenance costs, natural disasters, liquidity issues. Understanding these risks helps investors make informed decisions. Is real estate a good investment? Real estate can be a powerful investment if you choose the right location, you verify documents properly, you have long-term patience, you understand the costs involved, you are prepared for low liquidity. It is not a quick profit investment. It is a long-term wealth-building tool. Conclusion. Real estate investment is one of the oldest and most trusted ways to build wealth. It offers two major sources of income, rental income and capital appreciation. However, it also comes with challenges such as legal complexity, high investment cost, and difficulty in measuring returns. For investors who understand the market, perform proper due diligence, and think long-term, real estate can be a stable and rewarding asset class. But like any investment, it requires knowledge, patience, and careful planning. Thank you for visiting my channel. Like and subscribe if you like the content.